The Essays of Warren Buffett. Lessons for Corporate America.
A classic.
Yeah, and you asked us to really, get under the skin of this book, to pull out how Buffett thinks differently, his substitutive principles, and give a solid, comprehensive summary. So that's exactly what we're going to do.
And it's quite a task, but fascinating.
Right.
Because this book, well, it essentially pulls together decades of Warren Buffett's wisdom from his annual Berkshire Hathaway shareholder letters.
Those letters are legendary, right? Studied for over 40 years.
Absolutely. And Buffett himself apparently says this collection by Lawrence Cunningham is the book he signs the most often. That really tells you something about its weight.
It says a lot. It's clearly important for managers, investors, corporate directors, anyone really involved in business.
Definitely. It's not just about picking stocks. It's fundamental principles for running things, thinking about value, corporate responsibility.
And it's amazing how relevant those core ideas still feel, even with how much business has changed.
Yeah, the periodic updates show that. The philosophy applies to new stuff, but the basic truths don't really change.
Okay, so let's dig in. What's the big picture, the philosophy that holds it all together?
Well, the absolute bedrock is what he calls the owner's mindset. Simple idea, really profound impact.
Owner's mindset, okay.
He believes the smartest way to invest and really to manage a business too, is to think like you actually own the whole thing, not like you're just trading stocks.
So buy a business, not its stock. That's his line, isn't it?
That's the one, and it forces you, to look past the ticker.
Right. Understand the actual business.
Yeah.
What does it do? What's its edge, those economic moats he talks about?
Exactly. And crucially, what's its long-term earnings power? Can it keep making more money down the road?
So you need deep analysis.
Totally. Like he said back in '96, you want a piece of a business you can understand that's almost certain to earn materially more in the future. And importantly, you buy it at a rational price.
It all comes back to that long-term view.
Time and again. That famous quote, if you aren't willing to own a stock for 10 years, don't even think about owning it for 10 minutes.
Yeah, that really separates investing from just, gambling on short-term moves.
Precisely. And you can't talk about Buffett without mentioning Benjamin Graham, his mentor.
The value investing guru.
Right. Buffett really internalized Graham's big insight. Price is what you pay, value is what you get.
And they're almost never the same thing.
Exactly. Buffett's always hammering that point. The smart investor or the smart manager buying a company is laser focused on finding that gap where the price is way below the real intrinsic value.
Okay, so foundation, owner thinking, long-term focus, intrinsic value.
Got it.
Now let's talk about where he really breaks from the pack,
Mm-hmm.
these substitutive principles you mentioned. Where does Buffett offer a different way?
Yeah, this is where it gets really interesting. He basically takes decades of experience and uses it to challenge, sometimes outright reject, core ideas from modern finance theory, MFT.
Ah, MFT, like the efficient market hypothesis.
That's a big one. The idea that markets are super efficient, prices reflect all info instantly, so you can't really beat the market consistently.
Yeah, the don't bother trying to pick stocks idea.
Buffett, well, he politely disagrees. He'd say markets are mostly rational, sure, but they definitely do crazy things sometimes.
Especially in panics or bubbles.
Exactly. His own record, and others, shows prices do disconnect from underlying value quite often. He's not saying market timing works, but finding undervalued gems, absolutely possible if you do the work.
Okay, so if markets aren't perfectly efficient, how does he view risk? Because MFT often uses beta price volatility as the main risk measure.
Right. And Buffett pretty much throws that concept out the window, at least as a measure of true investment risk.
So what is risk for him?
It's the chance of permanent capital loss, losing your money for good. That comes from misunderstanding the business or the business itself deteriorating or simply paying way too much in the first place.
Not just the stock price bouncing around.
No. He finds it kind of funny how a stock that's crashed is suddenly riskier, according to Beta, even if the underlying business value hasn't changed much. That doesn't make sense if you think like an owner.
That's a huge distinction. Focusing on the business fundamentals, not the market noise. What about diversification then? Isn't that Finance 101, spread your risk?
It is, but Buffett offers a substitute there too. He argues that for investors who really know their stuff, who operate in their circle of competence.
Meaning they understand the businesses deeply.
Yes, for them, a concentrated portfolio, putting more money into fewer high-conviction ideas can actually lower risk.
Put all your eggs in one basket and watch that basket very carefully.
That's the one. He'd rather own a lot of a few great businesses he understands inside out than a tiny bit of many he barely knows.
Definitely challenges conventional wisdom. Okay, let's switch to accounting. Financials can be, well, tricky. How does Buffett cut through that?
This is critical. He substitutes reliance on standard metrics like GAAP earnings or even EBITDA with a focus on what he calls owner earnings.
Inner earnings. Okay, break that down for us.
Basically, it's the real cash flow a business generates. Think net income, add back depreciation and other non-cash charges, but then, and this is key, subtract the average annual amount of capital expenditures needed just to maintain the business's operations and competitive position.
So the cash that's truly free and clear for the owners after keeping the business humming.
Exactly. That's why he famously called EBITDA bullshit earnings, because it ignores the reality that you have to spend money on CapEx just to stay in the game.
It paints too rosy a picture by ignoring necessary reinvestment.
Precisely. He talks about the cash flow fallacy, thinking operating earnings plus depreciation equals cash you can spend. You must account for that maintenance CapEx. Owner earnings gives you that grounded, realistic view.
Makes total sense. Okay, how about managing businesses? Berkshire Hathaway is huge, but run differently, isn't it?
Very differently. And here's another substitute. Decentralized management. Instead of a massive HQ micromanaging everything.
Which is common in big companies.
Right. Buffett prefers buying well-run businesses and then letting their existing managers keep running them with a lot of autonomy. Berkshire HQ is famously tiny, less than 30 people overseeing, 60-plus subsidiaries?
Incredible. So find great managers who think like owners and let them do their thing.
That's the philosophy. It's a huge contrast to centralized control.
And more broadly, in terms of business principles, what other substitutes does he champion?
He consistently swaps short-termism and trend chasing for disciplined long-term capital allocation based on deep research.
Patience and compounding.
Yeah. The name of the game is buying quality at sensible prices and just holding on. Building value steadily, not trying for quick wins or trading frantically.
Okay, so that theme keeps coming back. Long horizon, understand the economics, ignore the noise. Let's get into some specific areas from the essays. Corporate governance is a big one. What's his take?
Very owner-centric. Managers are stewards of shareholder capital, period. They need to act like it's their own money.
So, aligning management and shareholder interests is key.
Absolutely fundamental, and that requires transparency, candor, treating shareholders like actual partners, not just, faceless investors.
His own letters are the perfect example of that, right? Detailed, honest, even funny sometimes.
Exactly. He also likes smaller boards, people with real business savvy who own stock themselves, truly independent and aligned with owners.
And he's critical of some pay packages.
Very critical of comp plans, especially stock options, that don't really tie pay to creating long-term intrinsic value. He doesn't like rewarding managers just because the market went up or time passed. He wants them to only eat what they kill. Pay tied directly to building the business's underlying worth.
Makes sense. Okay, moving to M&A mergers and acquisitions. A lot of money gets spent here, not always wisely. Buffett's approach.
Very distinctive. Berkshire almost always buys entire businesses, planning to keep them forever, and they really value keeping the existing management in place, giving them freedom.
So no hostile takeovers usually.
He avoids them, prefers friendly deals with owner-managers who want to stay. He's also deeply skeptical of deals driven by ego or just wanting to be bigger, or that deal-making beats working thrill.
The empire-building trap.
Right. And he especially hates using overvalued stock to buy a fairly valued company that just destroys value for your existing shareholders.
Yeah, you're giving away too much of your own company, then.
Exactly. Intrinsic value is paramount in any deal. Berkshire buys only when the price is well below what they think the company is truly worth. Interestingly, he also likes Berkshire's own stock to trade near its intrinsic value.
Why is that?
It attracts the right kind of shareholder, long-term, business-focused people. And if Berkshire stock is cheap, below intrinsic value, he thinks buying back shares is often the best use of cash, much better than overpaying for an acquisition with cheap stock.
So again, patient, value-driven, focused on quality and long-term fit. Let's circle back to financial reporting and metrics. You mentioned owner earnings, but what else?
Well, the whole point is using financials to truly understand the business's health and cash generation. Accounting is a tool, not the final word.
And owner earnings is the key metric for that understanding.
It's central. He sees it as way more accurate than GAAP net income for figuring out true profitability and ultimately intrinsic value, the discounted value of future cash flows.
Cutting through accounting distortions.
Right. Things like purchase accounting and mergers can muddy the waters of GAAP earnings. Owner earnings gives you economic reality. And it avoids that cash flow fallacy. You must account for maintenance CapEx.
You mentioned goodwill earlier, too. Economic versus accounting.
Yeah, accounting goodwill from acquisitions gets amortized, a non-cash charge he thinks you should mostly ignore for ongoing performance. Economic goodwill, that's the real stuff, the earnings power from brands, moats, etc. Owner earnings helps reveal that.
And it links back to capital allocation decisions.
Absolutely. The test is, for every dollar kept in the business, does management create at least $1 of market value over time? If not, give the cash back via dividends or buybacks.
Think like an owner. It always comes back to that.
And it means judging managers by return on equity, not just EPS growth. Berkshire even reports owner earnings supplementally to make things clear.
And throughout all this financial digging, there's that margin of safety.
Graham's cornerstone, absolutely critical for Buffett: buy with a buffer. Pay significantly less than your estimate of intrinsic value. Protects you if you're wrong or things go unexpectedly sour.
And he hates metrics designed to make bad deals look good.
Oh, yeah. Bullshit metrics. Ignoring real costs like depreciation or interest to pretty up the numbers. He has no time for that.
Okay, let's pivot to investment strategy itself. What are the core rules?
Rule 1. Think long-term, always. The stock market is a device for transferring money from the impatient to the patient. Tune out the daily noise. Focus on the business.
And use Mr. Market.
Use Mr. Market's moods. That analogy, your manic depressive partner offering crazy prices daily. Take advantage when he's pessimistic and selling cheap. But Buffett's main game isn't trading Mr. Market's swings. It's finding great businesses to hold.
Businesses with those economic moats.
Crucial, sustainable competitive advantages. Strong brands, network effects, low costs. Things that protect profits long term.
He likes the inevitables, right? Easy to understand businesses likely to grow for ages.
Exactly. Think Coca-Cola, Gillette in their prime. Businesses benefiting from broad trends, and for investors who understand these well.
Concentrate your bets.
Yes. Better to know a few companies deeply than many superficially. Watch that basket carefully. He also distinguishes speculation, pure betting, from arbitrage, which he sees as lower risk plays on announced deals. His success there shows markets aren't perfectly efficient.
And learning to buy great companies at fair prices, not just cheap cigar butts.
That was a key evolution for him. Quality matters. And sometimes the best action is inaction. Resist the urge to constantly trade. Welcome market drops as buying opportunities.
Like sales at your favorite store. Finally, management teams. What does he look for?
Rationality and candor. Above all, logical decision makers who tell shareholders the truth, good and bad. Managers focused on return on equity, owner earnings, profit margins.
And that key test, creating at least $1 of value for every $1 retained.
That's the benchmark. He also stresses how vital and difficult picking the right CEO is, and he advises hiring people bigger than yourself, more talented in their roles.
And letting them run things, like at Berkshire.
That decentralized model, again, grant autonomy to passionate, capable managers. Insist on candid reporting, up and down the chain. And tie their incentives to their unit's performance, not just Berkshire's overall stock price. Creates better alignment.
Okay, so wrapping this all up, what's the single biggest message from the essays?
I think it's that relentless focus on long-term value creation. It comes from treating shareholders as true partners and making sure management's interests are aligned with the owners.
And offering those substitute principles as alternatives.
Yeah, challenging conventional wisdom, thinking like an owner, understanding intrinsic value, prioritizing quality over quick gains, cutting through the noise. It's a whole different mindset.
So a final thought for our listeners to chew on.
Just imagine. Consider how your own view of business, of investing, might shift if you really adopted just 2 core Buffett ideas. First, focusing relentlessly on owner earnings to see true profitability. Second, demanding evidence of a durable economic moat before investing.
Moving beyond standard metrics and market hype.
Exactly. If you make that shift, adopting that long-term owner-centric view, well, you start seeing the world of business and investment with a clarity most people never achieve.